Hi, these are 3 places that you can put your money in order with your retirement savings. I just want to make a disclaimer, I'm not a financial advisor. I am a life insurance agent, but I am familiar with these instruments because I've had many of them in my lifetime. So let's start with the first order, right? Free money. Well, where can you get free money? That's the 401k that your company matches. You should always contribute to your 401k at least to get their match. That's free money. The second is tax-free money. So tax-free vehicles are things like Roth IRA and life insurance. And then the third is, once you've exhausted all the limits of the first two, is tax later money, and that's what you would think of a traditional IRA. So the question I normally get is like, well, why don't I put as much money as possible in my 401k? Well, here's the two things about a 401k. The good news about a 401k is there's a company match. The second is it's taken out of our paycheck and we sort of don't know about it, right? And the truth is, if it wouldn't be for 401ks, many of us would not be saving very much at all for retirement. So that's a good thing. The downside is a 401k is at risk for two main things: future taxes and market risk. This is what I mean by that. So in a 401k, you don't pay any taxes now, right? Your money goes to a 401k pre-tax dollars. So you do get a tax break now, but you will have to pay taxes in the future whenever you take that money out. And do you think taxes are going to go up or down in the future? That's up to you, right? At any rate, you're at risk for future taxes. The second is market risk. A 401k is a brokerage account, which means it's in the stock market. And so when the stock market does well, the 401k makes money. But when the stock market goes down, your 401k loses money. So for example, let's say you make $100,000 a year. And I'm saying $100,000 because it's just a nice round number to make the math work, right? And traditional advice says you should save at least 10% of your income towards retirement. So that's $10,000 a year or $833 a month. Let's say your company matches you 4%. So you should at least, which is $4,000 a year. So you should at least contribute $4,000 a year to your company-sponsored 401k plan. That's $330 a month. So you've got $500 left over, and that is where you should put towards a tax-free vehicle like a Roth IRA or life insurance. In this example, we'll say put $500 toward a permanent life insurance policy that gives you permanent life insurance protection and also builds a nice cash value account.